ahead is a challenging one, and it'll test the resilience of many emerging and developing countries. 2016 should be a little bit better in the sense that commodity prices will stabilize.
So your forecast seems to suggest that the world economy could be getting better, but is more likely to get worse.
There are sizable downside risks to global growth in 2016. And our main concern is that a number of emerging markets slow at the same time. For example, we estimate that if BRICS growth slows by 1 percentage point, global growth would be lower by 0.4 percentage points, and other emerging markets will suffer more. Their growth rates might be lower by 0.8 percentage points. So there's a real risk that the large emerging markets slow, and with them other emerging markets slow, and that then derails a fragile recovery in advanced markets.
About China's stock markets, will we see an end to that volatility? Is that volatility disruptive?
It reminds a little bit of last summer, where there was also a sharp stock market correction in China. And last summer also, the authorities monitored it carefully. They took steps to calm markets as appropriate. And the impact on the real economy really wasn't that big, because there was early policy action to calm markets. So we would expect the same to happen.
So the slowdown in the Chinese economy, inevitable and probably desirable.
Yeah, the slowdown is long planned. It's a move towards a more sustainable growth rate, and it's still a high growth rate. Even if China grows at 6.7% as we expect in 2016, it's still much higher growth rate than in most advanced markets and in many emerging markets also. And it's a deliberate policy move towards a more sustainable growth rate.
Are we likely to see the benefits from cheaper commodity prices, cheaper oil prices, feeding through into greater economic growth in the world economy?
In principle, it should, but it takes time for the benefits of lower oil prices to materialize. What we have seen so far is adjustment costs in commodity exporting countries, where growth has been sharply lower, much less than we had expected, more than a percentage point. And we have seen that vulnerabilities in oil importing countries have lessened. So in oil importing countries, fiscal deficits have lessened because subsidies are less. Inflation has come down because oil prices, energy prices are going down. What we have yet to see is the benefits to growth in oil importing countries.
It's a pretty benign time in the global economy, isn't it?
That is why 2016 is such a test for developing countries. Can they adjust to an era of low commodity prices and weak global trade, and at the same time adjust to rising interest rates while conditions are still fairly benign?